In June 2024, Saudi Arabia did something it hasn't done in 50 years. It sold oil to China, and China paid in yuan, not dollars. This wasn't a headline. Most people missed it, but central banks around the world didn't miss it, because for half a century, there was one rule in global energy markets, one absolute unbreakable rule. Oil is sold in dollars, only dollars, always dollars, until it wasn't. This isn't just about oil, it's about the architecture of global power. For 80 years, the United States has controlled the world not through military force alone, but through the dollar. Every country that trades needs dollars. Every central bank holds dollars. Every commodity is priced in dollars. The dollar isn't just American currency, it's the operating system of the global economy. And that operating system is starting to crash. Welcome to the Financial Detective, where legacy meets leverage and the truth is always buried in the fine print. Most people think the dollar power comes from the size of the American economy, from American military strength, from trust in American institutions. Those things matter, but they're not the foundation. The foundation is a deal made in 1944 in a hotel in New Hampshire and another deal made in 1973 in the deserts of Saudi Arabia. Two agreements that turned American currency into global obligation, and both of those deals are unraveling right now. Let's go back to where it started. 1944. World War II is ending. Europe is destroyed. Asia is in ruins. The Soviet Union has lost 27 million people. Japan's cities are ash. Germany is occupied. Britain is bankrupt. And the United States, protected by two oceans, emerges untouched. American factories are intact. American infrastructure is functioning, and America holds more than half of the world's monetary gold. At Bretton Woods, a resort hotel in New Hampshire, representatives from 44 countries gather to redesign the global monetary system. The question is simple. What will replace gold as the foundation of international trade? Because there isn't enough gold to support the reconstruction that needs to happen. Not enough to rebuild Europe, not enough to finance the expansion of global trade. The answer is the US dollar, but not just as another currency, as the reserve currency. The Bretton Woods Agreement makes the dollar the center of the system. Every other currency will peg to the dollar, and the dollar will be backed by gold at $35 per ounce, fixed, guaranteed, as good as gold. This gives America an extraordinary privilege. The US can print money to buy imports. Every other country has to earn dollars by selling goods to America or to other countries that have dollars. The US runs deficits. The world finances them, because everyone needs dollars to function, to trade, to buy oil, to hold as reserves. It's the greatest economic advantage in history, the ability to borrow in your own currency with a guarantee that global demand will never disappear. Because the demand isn't voluntary, it's structural, built into the system. But here's where it gets interesting. In 1971, Richard Nixon ends the gold standard. The dollar is no longer backed by gold, it's backed by nothing. Just trust, just faith in American economic strength. Most analysts predicted this would destroy dollar dominance. Without gold backing, why would anyone hold dollars? They held dollars for the same reason they always had, because they needed them. Because by 1971, the global economy was so deeply integrated into the dollar system that switching was impossible. Every contract, every bond, every trade agreement, all denominated in dollars. The cost of leaving was higher than the cost of staying. But Nixon and his Secretary of State, Henry Kissinger, understood something. They understood that faith alone isn't enough. The dollar needed an anchor, something that would guarantee permanent demand even without gold. They found it in oil. In 1973, after the OPEC oil embargo that created gas lines across America, the United States makes a deal with Saudi Arabia. The Saudis, largest oil exporter in the world, will sell oil exclusively in US dollars. In exchange, the United States will provide military protection, advanced weapons, and a guarantee of regime security. The Saudi royal family gets protection from internal and external threats. Within a few years, nearly all global oil trade is denominated in dollars. Not because it's more efficient, not because the dollar is more stable, but because that's the price of access to American military protection and financial markets. This is the petrodollar system, and it's brilliant in its simplicity because oil isn't optional. You can choose not to trade with China. You can decide not to buy German cars. You can avoid Brazilian soybeans. But you can't avoid oil. Your economy runs on it. Your military depends on it. Your people need it for heat, for transportation, for the plastics in their phones, for the fertilizer that grows their food, for the asphalt on their roads, which means you need dollars, not want, need. Every barrel of oil purchased anywhere in the world creates demand for US currency. Every country needs dollar reserves to ensure they can buy oil when they need it. Those reserves don't sit idle. They get invested in US Treasury bonds, which means oil exporting countries are lending their oil revenues back to the US government at low interest rates. It's not a trade system. It's a tax, a tribute system dressed up as free market economics. Every country that buys oil is funding the US government, whether they want to or not. Whether they're allies or enemies, whether they approve of US foreign policy or despise it. If you need oil, you pay the dollar tax. And for 50 years, it worked perfectly. Saudi Arabia got security and weapons. The US got the ability to print money that the entire world was obligated to hold. Other countries complained quietly but complied because the alternative was being cut off from the dollar system. And being cut off meant economic isolation, collapse. The system was self-reinforcing. The more countries held dollars, the more valuable the dollar became. The more valuable the dollar became, the more countries wanted to hold it. It was a closed loop of power, unbreakable, permanent, until it wasn't. The first crack appeared not from economics but from politics. In February 2022, Russia invades Ukraine. The Western response is immediate: sanctions, asset freezes, and the nuclear option. Russia is cut off from SWIFT, the international payment system. Roughly $300 billion in Russian central bank reserves held in Western financial institutions are frozen. Not seized, frozen. Russia can see the money, but they can't access it. This isn't new. The US has weaponized the dollar before. Iran, Venezuela, North Korea, but those were smaller economies, pariah states. Russia is different. Russia is a G20 economy, a major energy exporter. And more importantly, Russia has relationships with countries that control half the world's population. China, India, Brazil, South Africa. Those countries watched what happened to Russia and learned a lesson the US didn't intend to teach. The dollar isn't just a currency, it's a leash to leash. And the leash can be yanked at any moment for political reasons. So they started building alternatives, quietly, incrementally, without announcements or grand declarations. Just practical adjustments to reduce dollar dependency. China and Russia begin settling trade in yuan and rubles. Brazil and China create a currency swap line. India buys Russian oil in rupees. The United Arab Emirates accepts yuan for oil sales. Saudi Arabia, America's closest Middle Eastern ally for 50 years, signs a currency swap agreement with China. And then, in 2024, Saudi Arabia sells oil to China in yuan. This is the moment, not the collapse, but the beginning of the end of dollar exclusivity, because once oil can be bought in other currencies, the entire foundation shifts. Countries no longer need to hold massive dollar reserves. Central banks can diversify. Trade can flow through other channels. The dollar doesn't disappear, but it stops being mandatory. And when something stops being mandatory, it becomes optional. And when it becomes optional, its value depends on choice, not structure. The numbers tell the story. In 2001, the dollar accounted for 73% of global central bank reserves. By 2023, it's down to 58%. That might not sound dramatic, but it represents trillions of dollars shifting out of US Treasury bonds into euros, yuan, gold, and other assets. And the trend is accelerating. Central banks are buying gold at the fastest pace in 50 years. In 2022 and 2023, global central bank gold purchases exceeded 1,000 tons per year. That's not a hedge against inflation. That's preparation for a world where the dollar can't be trusted as the sole store of value. China holds $800 billion in US Treasury bonds, but it's been slowly reducing that number. Not dumping it, that would crash the value of its own holdings, but not adding to it either. China's central bank has been net selling US treasuries for years while accumulating gold. Russia sold almost all of its dollar reserves before the invasion. It saw what was coming. Other countries are watching and learning. BRICS, the economic bloc of Brazil, Russia, India, China, and South Africa, is expanding. Saudi Arabia and the UAE are considering membership. Iran has joined. These countries represent 45% of global population, 35% of global GDP measured in purchasing power parity, and they're building trade systems that bypass the dollar, not because they hate America, but because dependency is vulnerability. And the more the US uses the dollar as a weapon, the more incentive other countries have to build alternatives. This is the paradox of weaponized currency. It's effective in the short term. Russia's economy contracted sharply after sanctions. But in the long term, it teaches every other country that dollar exposure is a risk that needs to be managed. So what replaces the dollar? The question assumes a single replacement, one currency that becomes the new global standard. That's not how this works. What replaces the dollar is a multipolar system. Yuan for trade with China, euros for trade with Europe, local currencies for regional trade, gold as a neutral reserve asset, digital currencies for specialized transactions. The dollar doesn't die. It just stops being the only option. And that's enough to fundamentally change American power, because here's what most people don't understand. The US doesn't just benefit from the dollar being the reserve currency. The entire American standard of living depends on it. The ability to run trillion-dollar deficits without triggering inflation, the ability to import more than it exports year after year, the ability to finance wars, social programs, and infrastructure with borrowed money that foreign central banks are obligated to buy. All of that depends on permanent global demand for dollars, and that demand is eroding. What happens when it erodes enough? When central banks hold 40% dollar reserves instead of 58%? When oil trades in multiple currencies instead of dollars exclusively? When China completes its Belt and Road network and trade flows through yuan-denominated channels instead of dollar pipes, interest rates in the US go up, not by choice, by necessity, because treasury bonds become less attractive to foreign buyers. The government has to offer higher yields to attract purchases, which means more of the federal budget goes to interest payments instead of programs. In 2024, the US paid over $600 billion just in interest on the national debt. That's more than defense spending, more than education. If yields go up another percentage point, that number becomes $900 billion, 2 percentage points, $1.2 trillion, which means less for everything else. Or more borrowing to cover the gap, or more printing to monetize the debt, and more printing eventually means inflation. Real inflation. Not the transitory kind that central banks promise will fade, the structural kind that embeds itself in the economy and erodes purchasing power year after year. The inflation isn't immediate. The dollar has been losing reserve status for 20 years, and inflation only spiked recently during COVID. But that's because the process has been slow enough to absorb. If dedollarization accelerates, if central banks dump treasury bonds instead of slowly reducing holdings, if oil exporters suddenly shift to yuan and euros, the impact compresses from decades into years. American consumers feel it first, not through economics textbooks, through price. The TV made in China costs 30% more because the dollar buys fewer yuan. The t-shirt sewn in Bangladesh costs more because Bangladesh is settling trade with China in yuan and doesn't need as many dollars. The car built in Germany costs more because the euro has strengthened against the dollar. Imports get expensive across the board. Electronics, clothing, cars, furniture, toys, appliances, everything made abroad, which is most consumer goods in America, costs more. Not because of tariffs, not because of supply chains, because the currency everyone held for 80 years is slowly becoming the currency people hold less of. Wages don't keep up. They never do. The middle class gets squeezed between rising prices and stagnant income. The cost of living climbs. The quality of life declines. And most people don't understand why. They blame inflation. They blame corporations. They blame politicians. But the root cause is deeper. It's the unwinding of a monetary privilege that lasted 3 generations. But this isn't just an American problem. It's a global disruption that ripples across every economy. Countries holding trillions in dollar reserves watch those reserves lose purchasing power. China holds over 3 trillion in dollar-denominated assets. Japan holds over 1 trillion. Germany, South Korea, Taiwan, Saudi Arabia, Arabia. All of them lose wealth, not through economic failure or bad decisions, but through currency depreciation they can't control. They're trapped. If they sell their dollar holdings too fast, they crash the value of the assets they're trying to preserve. If they hold too long, they watch those assets erode. So they do what everyone does in a slow-motion crisis. They hedge, they diversify, they reduce exposure gradually, and hope they're not the last one out. The question isn't who wins, the question is who loses least. China loses if the dollar collapses too quickly. They hold too much dollar debt. But they gain if the Yuan becomes a regional reserve currency. Russia loses oil revenue if global trade destabilizes, but they gain freedom from dollar sanctions. Europe loses stability as the global system fragments. But the euro gains importance as an alternative. It's a prisoner's dilemma. Everyone would be better off if the dollar remained stable. But no one wants to be the last one holding dollars when the shift accelerates. So everyone hedges, everyone diversifies. And the diversification itself accelerates the decline. This is how currencies lose reserve status, not through crisis, through drift. The British pound was the global reserve currency for a century. From the 1820s to the 1920s, the pound was what the dollar is now. The currency of global trade, the anchor of the international monetary system. World War I damaged it. The US became the largest creditor, but the pound held on. It wasn't until World War II, until Britain was bankrupted by the war effort, that the pound finally lost its status. Not in a single moment, but across 2 decades of decline from the 1940s to the 1960s. The dollar's decline started in 2001, when it held 73% of reserves. We're now at 58%. The trajectory is clear. Whether it takes 20 years or 40, the direction is set. The dollar will remain important, but it won't remain dominant, and dominance is what gave the US its unique advantages: the ability to borrow without limit, the ability to sanction without consequence, the ability to print money without immediate inflation. All of that depended on the dollar being mandatory for global trade. Once it's optional, those advantages disappear. Most people won't notice the transition. It will happen in central bank reserve allocation decisions, in trade settlement agreements between countries, in currency swap lines negotiated behind closed doors, in oil contracts denominated in yuan instead of dollars. Gas station price might rise. The grocery bill might climb. The paycheck might not stretch as far. But the connection to dollar decline won't be obvious. The causality will be buried under layers of economic complexity that most people don't have time to understand. That's the genius of slow systemic change. By the time everyone notices, it's already done. The world has already moved on. And the benefits that seemed permanent, that seemed like natural laws of economics, reveal themselves to have been temporary privileges built on a specific arrangement of power that no longer exists. The dollar era is ending. Not this year, probably not next year, but the direction is set. The deals that made it possible are unraveling. The Saudi Petrodollar agreement is done. The Bretton Woods system ended 50 years ago. What remains is inertia, and inertia eventually stops. What replaces it won't be better, just different, more fragmented, more unstable, more uncertain, more uncertain. The next era won't have a single reserve currency. It will have several regional currencies, commodity-backed alternatives, and digital experiments. Some will succeed. Most will fail, and the transition will be expensive for everyone. That's the truth. They don't teach in economics classes. Currency dominance isn't earned. It's taken, held, and eventually lost. The dollar's turn is ending. The question isn't whether it happens. The question is who's prepared when it does. If this gave you a new perspective, hit subscribe. Where legacy meets leverage, and the truth is always buried in the fine print.